Canadians got a lot of economic news this week, which could affect their bottom lines. Now, on Wednesday, the Bank of Canada lowered the key lending rate, and it could be forced to do it again after today's job numbers. Statistics Canada showed that Canada's unemployment rate went up in August as the labour market continues to cool. Have a look at this. Canada added 22,000 jobs in August, and it pushed unemployment rate to 6.6%. It's an increase of 0.2 percentage points from July. Now, that may not seem like a lot, but it means our employment rate is now at a 7-year high. And it doesn't count those pandemic years. That's the unemployment rate. Now, the labor market numbers come just 2 days after we saw a third consecutive lowering of interest rates by the Bank of Canada, meaning your mortgage cost should be going down. But will these job numbers push the central bank to make an even more aggressive cut in October? Well, let's ask our chief economist. Joining us right now are Jimmy Jean, vice president and chief economist for Desjardins, and the chief economist at Scotiabank, Jean-François Perrault. Thank you both for joining us and for being here.
Thanks for having us.
Jimmy, we're going to start with you on this one. Some people may see the job numbers today as bad news. How are you looking at them?
I think it could have been much worse. We had job growth pretty much in line with what was expected. However, yes, when you dig under the hood, when you look under the hood, you see that the part-time factor was the main component of job creation. And, that's also speaks to why you've seen a 0.1% decline in hours worked, which is not exactly reflective of a very dynamic labor market. You also see that the gain was driven by education, which might be seasonal effect not fully being controlled for by these statistics. So, there are things that are still worrisome when you look at the job market picture. I tend to focus more on another survey that Statistics Canada produces that tends to survey businesses directly. And the last reading we had was a decline of 47,000. So that was worrisome. And I think that's why you've seen the Bank of Canada adopt that stance whereby it is ready to do more if it feels things are deteriorating further in the job market.
Jean-François, do you think that this is a clear sign that the measures taken by the Bank of Canada are actually working now?
I think it's certainly evidence of some of that impact. I mean, we shouldn't be surprised at this point in the business cycle for the job market's kind of performance, right? It's the culmination of a couple of years of interest rate increases that were designed very specifically to slow the economy. And one of the ways in which the economy slows is through a weaker job market, and we're seeing that. So the fact that we are seeing that, as disappointing as it is to some people who have lost their jobs, which aren't that many, but it's still, the unemployment's going up. So there's some people that are, struggling as a result of this. The reality is that a stronger job market, if we were to see that, would mean that the Bank of Canada would feel less pressure to cut interest rates. So this is kind of part and parcel. A weaker job market is reflective of the fact that rates had been high and the central bank is cutting, and the weakish job market that we are in is indicative that they are on a path to continue to do that as we go forward. And that's probably a good thing at this point.
Yeah, and Jimmy, I wanted to go back to that because I think that's where a lot of Canadians' attention was this week. The Bank of Canada Governor Tiff Macklem told reporters that in those deliberations that they were having before making the rate cut, that they were considering 0.5 percentage point, but really settled on 25 basis points instead. Do you think that this will give them more of an impetus in October to go with that 0.5 percentage point cut and be a little more aggressive going forward?
Well, there's still a lot of time between now and that next meeting. So I think they'll parse the upcoming data, be it on inflation or be it on economic growth. There's going to be another job market number that they'll be able to analyze thoroughly. But I think the big picture is that, interest rates, even at 4.25%, are still quite high in this country, given the debt that we have, and also given the headwinds to grow that we are currently experiencing. For example, for the third quarter, we're tracking around 1% GDP growth, and the Bank of Canada back in July was expecting 2.8%. So growth is coming in weaker than they expected. They've commented about how how much slack the Canadian economy already has. So you could make a case that it's time now to go with a bigger and more forceful gesture. So I think a 50 basis point cut in October is well on the table. Not ready to make that call just yet. We're going to see the next set of numbers. But, I think right now it's clear that the risk pendulum has shifted towards growth and the labor market. It's no longer about inflation. Inflation is at 2.5%. And when we look at core measures, they're pretty much at very close to the target. So no need to focus on that all that much.
Yeah, and Jean-François, I mean, one of the factors that is obviously considered here is the U.S. Federal Reserve, and it's signaling that it's ready to kick off a series of interest rate cuts. What kind of cues is Canada taking from our American counterparts?
I'm not sure that they're taking that many cues. I mean, the governor's been at pains over the last couple of meetings to indicate that he's setting monetary policy for the needs of Canada, and the Fed will do what the Fed needs to do for the U.S. Now, there is a debate as to whether or not the Fed moves by 50 basis points next week, which is its next meeting. We don't think that's going to be the case, but the markets are pricing in more than a 25 basis point cut. So it's a real issue. I think the question becomes from the Bank of Canada perspective is if the Fed feels compelled to move very aggressively, 50 basis points or, more than that in the next few meetings, is that reflective of the fact that the U.S. economy is slowing much more than anticipated? And if so, of course, a weaker U.S. means a weaker Canada, all things being equal. So there is a possibility that if the Fed does feel compelled to act on the basis of what it perceives to be the weaknesses in the U.S. economy, that influences how the governor of the Bank of Canada might think about his economic forecast and, of course, the setting of monetary policy in Canada then because of the external environment.
So, Jimmy, in terms of people and Canadians at home expecting their mortgage payments and loan costs, what should they be looking at as we go to the end of this year? Should people be looking for a little relief?
Well, certainly those that are on variable rate mortgages, they've seen quite a bit of relief in the last few months, and that's likely to continue. We expect at the very least 2 other cuts by the Bank of Canada as we head into the end of this year. And we expect 6 further 25 basis point cuts in 2025. So those that have been suffering under the plight of higher interest rates with variable rate mortgages, those will see the benefit. Now, when, if you're looking at a fixed rate mortgage, you're seeing declines, but much slower. The markets are already embedding what's ahead, and so it will take surprises, I guess, from central banks to really move the needle further on that front. And we know that mortgage rates are still going to be way higher than they were back in 2020 or 2021. But at the very least, they're not going higher. And for some people, that's just what they need to be confident in investing in the housing market. So better days ahead. But I think it's going to take some time before it has a full impact on the Canadian economy.
Jean-François, I'll give you the last 30 seconds here.
I mean, I think that's right. I mean, the only debate there is in Canada really with respect to monetary policy is, how much and how quickly will they move? It's not a debate as to whether or not they're going to go further. A couple of other cuts this year seems reasonable to us, and then a few more next year, that seems eminently reasonable. The only challenge to that is we know that there is some pent-up demand in the economy. We know that the rate-sensitive parts of the economy have been held back by higher interest rates. So there's a concern as you lower interest rates that perhaps the housing market turns around very quickly, which would be good for folks that are trying to sell their place, but not good for a central bank that's trying to moderate the pace of economic activity. Of course, the prices that come with that. And the governor talked a little bit about that this week, actually, when he explained his reasoning behind their rate call.
All right, Jean-François Perrault from Scotiabank and Jimmy Jean from Desjardins. Thank you both for joining us. We appreciate this.
You're very welcome. Thank you.
Thank you.